Hello, good evening, everyone. Welcome to all of you for today's session. Students, just let me know whether you people can hear me well. Can you hear me well? All right. So our topic for today, that is audit risk. So exam focus points, we will directly shift to that. Let me share with you the Drive link for the notes as well, so that you can download these notes meanwhile. And on weekly basis, I will be updating this drive and will be sharing, every week the notes will be uploaded here. Here you go. So, students, audit risk. So, what is tested in audit risk in audit and assurance exam? So, you are given exam scenario in section B of your paper. In section B of your paper, you are given exam scenario, and in that scenario, they ask you for around 16 marks normally, 12 to 16 marks. Normally 16 marks. They say explain or describe audit risks and audit response. So they ask you to describe audit risk in the scenario being faced by the company and audit response to each risk. Response to each risk. Identify and explain. I think it is like that. Yes. Yes, like this. So two parts are there. And you always be solving in the answer part in this tabular format. So audit risk and audit response like this. So you will write an audit risk here, explain, and its audit response here in front of that. There will be no other way to discuss it. Only this one way. Remember that. This format, the answer is acceptable. Now, the next is so examiner actually tests from you that you can identify risks. Audit risks means from the scenario. So it means you need to identify what is examiner is test, what examiner is testing. You need to do that, and you need to explain. Sorry, you need to explain each audit risks. This is explanation part. That how this risk is arising from this situation. I'm calling a certain issue or audit risk. How it is arising, what it can go wrong, what can go wrong in financial statement or audit. Sorry. What can go wrong in financial statements or audit? You have to elaborate. And then You will be giving audit response, but how to draft it, we will be talking about it. So students normally lose marks. Why? For the first part, today the whole topic is this basically. Identity, they don't explain actually. They identify the issue, but don't explain the risk. They may say financial statements may be misstated, but they forget to explain how, why they will be misstated because of this factor, because of it. How these financial statements may be misstated because of this factor. How? They forget. And audit response should always be relevant to address this risk. This cannot be generic. This cannot be addressing any other matter. Remember that. So if you write generic response and not addressing that risk of misstatement or that audit risk, you won't get marks. Now, the next point is audit risk model. It will not be repeated in exam. A quick explanation that audit risk is a function of, or it actually arises from two areas: risk of material misstatement in financial statement. That financial statements may be misstated because of nature of item, judgment is involved, estimation is involved, complex item. So nature of the item, or it arises because of some weak or missing controls in the company, control risk. So misstatement in financial statements, if that is high, audit risk is high, auditor's opinion may be inappropriate. And now the second factor is detection risk. That auditor has to detect misstatements. So the risk that auditor may be unable to detect. So audit risk arises because of these two factors. Now, so the first point is how audit risk is tested in exam. First of all, scenario specific matters. In the scenario, they have discussed some information that there is some accounting treatment either has been discussed incorrectly, some error is there in capital revenue expenditure, some provision is not recorded, or some similar, which some accounting issues. Development cost has been discussed, research cost has been discussed, inventory valuation has been discussed, that may be misstated, may not be recorded as per IFRS. So these are very easy marks if you know how to explain them. Now, there may be some generic points as well. That it is a new audit client. So how it is an audit risk? There is a weak controls in the company. Staff is incompetent. So how this is affecting financial statements? You must have to explain their impact. Explain. Link. So if you link the impact on financial statement and audit, it will be audit risk properly. Now, so students, let us explaining risk. So we said that audit risk is basically, we said that it arises because of risk of material misstatement and detection risk. So risk of material, some points will be misstatement, causing misstatement in financial statements. So each misstatement point, and in your exam, there will be around 80% points which will be linked to misstatements. Only 10 to 20% will be about detection risk. So you must know, first of all, you must be able to identify which one is detection risk and which one is risk of material misstatement. So detection risk points are quite straightforward. Just see here, there are tight deadlines for audit. So you may not be able to perform work properly. Use of expert or use service organization. Company is using some expert for valuation, for providing some service which is affecting financial statement. Auditor may not be able to obtain evidence about that. Client has multiple company which is being audited. There are multiple locations. Auditor may not be able to withdraw. So we will be talking about in detail how to write about them. So first of all, we must know what are the detection risks. So there are detection risks. And now how to explain them in exam to secure marks. So each audit risk explanation, when you say identify and explain, there are two sides. Audit risk and audit response. So audit risk side should explain three things. Issue from scenario. What is risky in the scenario or wrong in the scenario about financial statements? About financial statements. What can go? Yes. From where some misstatement may arise. Risk, how it arises. Why does that? You need to explain. We're saying, for example, the company has faulty paints in stock. Okay, at year end. So you have identified. So faulty paint, how it is a risk. You say it should be written down to its lower of cost and RV. The risk is that they may not have done it. It may be held at cost. Its NRV may be lower than cost. Now this is explanation why this creates risk, how this creates a risk. Now impact on financial statements. Which specific item in financial statement is understated or overstated? So but if the risk is that company may not have written it down, it may be overvalued and hence inventory may be overstated. Inventory may be overstated. Profits overstated as well, because if you write down, you have to write down in the profit and loss. So weak answer. There is risk that inventory may be misstated. Now, how to explain? Management has evaluated inventory at cost despite a significant increase in inventory levels or inventory days from the previous year. You will be analyzing that, which may indicate, now explanation. You see, this is the issue from scenario. They have, what is issue from scenario? This one. Issue from scenario. This and this. Now, how this creates a risk? Yes, this is the point. Developing the point. Since it is slow down, obsolete, chances are there. This is a risk. This is a risk. And this is impact on financial statements. IRI. This is the risk. How you will explain. Three things. For example, another student writes, management has recorded inventory at cost. and it may not have the same value. Inventory may be overfilled. Still, it is incomplete because you did not build the argument from the scenario where you analyze it is increased from, and you will give the argument that it increased from, for example, 3 million last year to 5 million. You find from the scenario. Or inventory days increase from 30 days to 40 days this year. So this is the argument. You need to write that over here as well. Building the argument, justifying how misstatement may arise. Now, so you see here other examples. Another example of inventory. Okay, so same has been explained above. Now, yes, there might be incorrect accounting treatment given. Company has capitalized interest on loan, which company took for building construction. And IS 23 borrowing cost says it should be capitalized as a part of the cost of asset. But the company has expensed incorrect treatment. This is the fact issue. You will not write in complete sentence. I will show you the complete answers as well. Here I have done breakdown. So IS 23 requires capitalization of interest should be done for qualifying assets. But they have done incorrect. So property, plant, equipment are understated. Profits also understated. Sorry. Because you have expensed that. You have expensed that. Now, another example. The company has offered provision for warranty on the products they are selling. So the company may not have recorded any provision if they have not recorded. Scenario is telling it, for example. So incorrect. Because issue, no provision recognized. And they have offered provision, offered warranty. We will tell the details of warranty in one line. So the company has to compensate to the customers. The risk is that they have to pay this amount, but not recognized. They have to spend this amount for this against the sales. So provision need to be recorded, which is not, so hence provision is understated and profits overstated. Now, so detection risk. For example, tight deadline. It is auditor's side problem. And this is financial statement side problem. You see, risk of material misstatement is financial statement side problem. Preparation, it is causing audit risk. And detection risk is auditor side. So tight deadline for audit. Auditor may not perform the work properly. Management is saying complete audit within 1 month or 2 months after the year end. Be quick. So the possibility is that so there is detection risk due to tight deadlines. You shouldn't explain. Weak. Now explanation how this is audit risk, how this is detection risk. Tight deadline increase detection risk as auditor procedures may be rushed or reduced in extent, increasing the likelihood that material misstatements remain undetected. How well explained. How this is risk, how it is affecting audit. Now, the next is audit response. I hope you have got the idea how to explain it. What are the components? Audit response, where students normally lose marks. Normally. Audit response must address the specific risk or misstatement you are discussing. This cannot be linked to any other aspect. For example, you are discussing the cost or NRV. Response cannot be on the physical verification of inventory existence. Response cannot be related to the completeness. Cannot be. You are discussing audit risk related to revaluation of assets. Response cannot be on completeness of assets. It cannot be on rights and obligation. No, not at all. So it must not be generic, must not be vague. It should be clear. For example, you say increase substantive testing on inventory. Which aspect? Incomplete. So perform additional substantive procedures in inventory evaluation. For example, still it is not complete, that much complete. To ensure you get marks, including reviewing post-year-end sale invoices to assess whether NRV is below cost or not. So you see how clear. Response is what action auditor will take now to tackle this audit risk. So it can be test of control, substantive tests, direction of work, or combination of all. It always match with the risk or misstatement. Very important. Audit response can be any of these things. Normally, response is what auditor will do to detect this misstatement, to detect this risk of misstatement. Okay? Now, what examiner says, these are the words from examiner I'm telling you. Students do not explain how risk arises, and they are not linking it impact on financial statement. They said financial statement may be misstated, where you can tell which specific item will be understated. You can tell, for example, based on information. And if you are writing over there that inventory may be misstated, it will be blunder. Because you can tell there it may be understated. Chances of understatements are there. You cannot generalize it over there. Remember that. Now, next point. So generic response is not related to scenario, don't attract marks. Now, students, remember, very exam tip, you see. Audit risk, scenario, explanation, financial statement impact, and targeted response. Okay, if you practice it again and again, apply this, your structure will become automatic. But it will happen doing 10, 15 scenarios, solving, applying these frameworks, checking that. It will not happen overnight. Because you have to develop this, mental model, your own, on this. It cannot happen overnight, I'm telling you. So, now, very important, I have analyzed your past papers and identified most commonly tested audit risks. I have gathered some. That what are the triggers present in scenario? how you need to explain audit risk and audit response. So the first one is development cost. You are reading the scenario. I have given some example. Of course, I cannot cover everything based on past papers. So the company has spent significant development expenditure. In the scenario, you get information. They're developing some product, some prototype. Project is in progress. No information available. Benefits uncertain. So this information may be present in the scenario. Now, these are issues basically. How to write issues? Development cost may have been capitalized, and you will mention the information from, for example, company has developed this much amount on developing this product, and they have capitalized this amount, for example. Now, risk, how it arises? IS 38 allows capitalization only when criteria are met. Technical feasibility, intention, ability to complete, future economic benefits. Now, management may capitalize cost too early or without evidence to boost assets and profits. This building the argument, this is very, very, very important because it is directly related to IS 38. So, hence, intangible assets may be overstated, expenses understated, and profits IS 38 breached. So your answer should combine these three things. When we write explain over there, of course you will not be writing here. You will not be writing issue. You will not be giving these three headings. But that paragraph you will be writing here. Okay? That should have these three components. Now, what is the risk you identified? You said that over here, that may not meet the criteria. This criteria. Okay? And they may have capitalized it. So review project documentation, budgets, feasibility studies to assess whether IS 38 criteria are met. Now, basically, budget, feasibility study are verifying these budgets and ensure any non-qualifying costs are expended. Now, what is it? It is a direction to perform substantive tests. Yeah, that you have to perform substantive tests on these areas to verify these. So it is direction of audit work. Now, the next point is another example. Revenue recognition is repeatedly tested in your exam. That the company has made a contract. Sometimes they have sold a product and they are offering warranty. Or they are offering some service for 1 full year and they receive money in advance. So what is the risk? Because performance obligation has to be done. The contract has to be performed over 1 year, 2 year, 3 year. Money is being received now. It should be recorded as deferred income and should be recorded on the over when the performance obligation is satisfied. When the performance obligation is satisfied. Now, you see, what is the issue? So the revenue has been recognized before performance obligation are satisfied. Under IFRS 15, revenue should be recognized when control is transferred, service is delivered. Management may accelerate revenues to meet targets and premature recognition. What is the impact? Revenue and profits overstated and deferred income understated. Now, this is the whole risk. What is the risk? Management may accelerate Cut-off error, premature recognition. This is the risk. Now, audit response, review customer contract. First of all, what is the duration of the contract? And perform cut-off testing around the year to ensure revenue only when. Now, again, it is the direction of audit work. Same. That perform substantive tasks. Auditor has to perform on cut-off testing of revenue and whether performance obligation is being satisfied or not. So you see here, response is addressing the risk directly. Nothing else. Next, inventory valuation. The next point, the third risk, most commonly tested. The company's sale is, so what are the information in the scenario? The company's sale is declining. Inventory or work in progress increasing. Inventory days increasing. Company has complex production and cost allocation system. Cost allocation system may not be right. Now, how to explain what is the issue? Significant inventory exists while sales are declining. You will build the argument by saying, for example, sale have been declined from this to this. Inventory have increased from this amount to this amount, from last year to this year. You will give this information from the scenario. So declining sales suggests reduced demand. Mean finished goods could be slow moving and NRV may fall below cost. And what about work in progress? The valuation is judgmental because the overheads have to be allocated. Errors or bias of management can inflate, can increase work in progress. Impact. Work inventory may be overstated, cost of sale understated, and profits. You see here, this is very much important to understand. Issue, how risk is arising and impact on financial statements. So now audit response must address it. The sale price perform additional substantive tests. On valuation, this is what we are saying. NRV may fall below cost, including post-year-end selling price, overhead allocation to assess inventory is above NRV or not. Assess, not verify, to assess above or below. So it is verifying inventory is recorded. Again, it is the direction of audit work that perform these substantive tests on these areas. Next, machinery useful life revised. The scenario is telling the company has increased useful life of machinery. Possibility is there. So what are the triggers in the scenario? So hence depreciation reduced. When depreciation reduced, profit improves. So deliberate, maybe on the wrong assumptions. Maybe depreciation may be understated. So useful life has been revised. Issue, lowering depreciation charge. Now, how Misstatement. What is the risk? Useful life is estimate. It can be extended without support to reduce or based on wrong assumptions. So depreciation will be understated. So what if profit and plant equipment overstated and profits as well? Now, so depreciation may be understated. So expense may be reduced. So assess the revised useful life of asset. Auditor has to assess using evidence, technical information, whatever is given in the scenario. Recalculate deficit chart to confirm it is reasonable and correctly recorded. Or not. So audit response is addressing that depreciation is appropriate or not. Now, the next is legal claim. That the customer or some supplier, some employee, or any third party has sued the company. They're asking for some compensation. So these facts are present in the court, in the case study. So now, how to discuss them IRI? So company is facing legal claim, which may create legal obligation. We need to support it with the argument from scenario, because each scenario may have different information. So outcomes and amounts are answered. Management may avoid recognizing a provision or may underestimate it to protect profit. So what is the impact? So provision may be understated, expense understated, and profits, so impacts on financial statements. You see here. So management may underestimate it. We said that. This is the, yes, risk. Probability of payment, amount of payment, and sometimes contingent liability and provision. So review legal correspondence and board minutes. Very good source to assess provision or contingent liability and verify it's measured at yes, at appropriate amount. So students, about the valuation probability of payment, amount, the response should address risk. First of all, before going to any question, you need to spend time on this handout. I'm telling you, you need to understand what is being said over here. It is actually making the foundation for you people to be able to solve scenarios. Now, yes, it happens. Company has obtained a loan, and the loan is to be paid in installment, repaid installment. Within next, for example, 5 years. In the next 5 years. So how to deal with it? First of all, issue. So it should be, the loan should be split into current liability and non-current liability. And interest should be calculated correctly. So current portion may not be correctly recorded. Interest may not be accrued correctly. Hence, liabilities may be misstated. Finance cost may be understated. Profits overstated. So how to verify? This is a risk. So review loan term to identify installments. Verify its correct split. And recalculate. Now, substantive test once again. A substantive test addressing the same issue we highlighted above. Remember that. Now, they say inventory is damaged, expired, spoiled, obsolete, so not saleable. So they have to sell at discount. So NRV may be lower than cost. Management may not write it down. You see how to explain this issue to avoid reducing profits. Hence, inventory may be overstated, cost of sale understated. So, inspect damaged inventory account and review post-year-end selling price to verify it is written down to NRV where required. So, it is directly addressing this issue, risk. Very important. Very important. So I told you, you need to practice it again and again and mark your each point, whether each point has these components. Now, new accounting or sales system introduced. Normally, you see, the company has introduced new sales system, new accounting system. So there might be issues. Staff may not be trained well, or that data transfer may not be from the old system to the new system may not be correct. There may be bugs in the new system. So this is a huge overall generic risk. So students, these are the facts from the case you will find. So issue, transactions are processed in new system. Configuration, data migration, staff may not be trained, well trained, incorrect posting, duplicate entries, may not be appropriate, control may not appropriate. So control risk is there. And so many items of financial detection risk may also be there. So many items of financial statement may be misstated. Now, being auditor, you need to check system. This is control testing. And extra substantive testing on transaction process by new system to confirm data transfer is accurate, system effectively working or not. So addressing this system is appropriate, new system, that financial statements prepared through that system can be relied upon or not. So you will be testing system, you will be testing the transactions, verify accuracy. And these are repeated risks, I'm telling you. In every past paper, you may find 2, 3 from these 15. Almost 2, 3 are minimum there. Now, research and development cost. So R&D, research and development costs grouped together. Company has not made restriction. Or the company has capitalized development costs which may not meet the correct criteria. Capitalize the criteria of IS 38. May have capitalized research cost and may not meet the criteria of, we have already explained it above as well once. Now, so yes. So you see here, issue. Of course, you will be utilizing the scenario information, that specific amounts, specific details to update this answer. This is generic discussion. So research must be cost must be expense, while development can be capitalized. Management may misclassify. So intangible assets may be overstated, expenses understated, profits overstated. So obtain R&D breakdown cost to confirm research is expense, and only development cost meeting criteria. Now you see here, this is direction of audit work. To this, yes. Now, next, brand and I-38 once again. Company has purchased brand. Company has purchased some license. Okay. So that should be amortized over the useful life. That may be impaired. Okay. May not have been impaired, may not have been amortized. And internally generated brands cannot be recorded as intangible asset. So these are the facts from the case. So issue you will discuss, whatever it is. Internally generated brands should not be kept alive. License must be amortized over useful life and impaired if indicator exists, whatever the condition. Again, scenario information. Whatever is relevant, you will write. Management may overstate intangible assets by incorrect recognition, incorrect amortization, or impairment. So intangible assets may be overstated, amortization understated, and profits overstated. Now, so verify whether brands are internally generated or purchased. Because only purchased can be capitalized. And review license terms to verify correct amortization. And impairment, again, where indicator exists. So substantive tests to be performed. Clear cut, detailed. Now, new audit client. Company is a new audit client. This audit firm is going to audit them for the first time. So, lack of knowledge of this company, their financial affairs. There might be, financial affairs the auditor may not know in deep. And opening balances are closing balance from the previous year. That may be misstated. So, issue. What is the risk? Knowledge may not be, planning may be weaker. Unusual balances may be missed. And opening balance may contain misstatements from the previous year. So detection risk is high. Opening balances may be misstated. Yes, how to respond to this? 1 and 2. How to respond? Perform extensive planning. Audit opening balances. Increase substantive tests to high risk area. Yes, you can write assign experienced audit team. That's also good. So multi-year maintenance contract. I think this is a repetition. We have already discussed above. It is a repetition. Okay. Now, so company have multiple stores where inventory is located. Operations are separate. Multiple locations. Auditor cannot attend all inventory counts, all counts. These are the triggers over there. Now, the next point is audit risk. How to explain? So inventory exists as multiple locations. So auditor cannot go and check everything, verify existence, hard to verify. So that may be misstated. Auditor may not be able to obtain evidence to increase detection risk. Auditor cannot, for example, company has 15 locations. So auditor may not have that much staff to attend all inventory counts same time. So how to deal with it? So those locations where material balances are there, big amounts, attend inventory counts there, and perform alternative procedures for those sites over existence and completeness. Alternative, that may be invoice checking, record checking, like that. Now, so addressing it, auditor may not be able to attend. So receivable days are increasing and customers are struggling to pay. So these might be, you find in the scenario, one customer is struggling to pay, big customer. Overall receivables are increasing. Now, so slow collection and customer distress threatens recoverability. Some balances may become recoverable. Management may understate allowance. So receivable may be overstated. Allowance should have been increased. Allowance should have been increased, which may be understated. So this is the risk. How to address? Review age receivable and inspect post-year-end cash received to assess recoverability and adequacy of allowance for doubtful debts. Same. Substantive tests to be performed. And the last point. Bonus or listing, loan covenant pressure. These 3 points. These are actually involves management bias. Management become biased to overstate profits, understate expenses. Management may be biased to understate liabilities, overstate assets. So these all create management bias. These triggers are present in the scenario that the company has bonuses, announced bonuses based on profits for its management, directors. Company is going to be listed or newly listed, even that as well. So new or companies negotiating new loans. So management will want to show better financial picture to get loans, to increase share price if it is going to be listed. Or it is already, covenants are there, covenants, conditions attached with loans. Loans already obtained by the company. So management may manipulate financial statement to ensure covenants are being complied with. That is management bias. So strong pressure, whatever the factor is, you will explain, and strong pressure. Estimations may be aggressive, may be manipulated to present better result to the investor or lender. Whatever the situation is, it is. So hence profits or assets may be overstated, liabilities understated. Going concern, disclosure issues that may not be properly given. So apply heightened skepticism. Perform additional substantive tests on judgmental areas affecting profits and net assets. Review estimates and recalculate covenants if there are covenants. So you have to basically, if I say you need to memorize this handout, I don't say normally memorize, but you must memorize it so that you can become foundation for the next questions. And again, I'm telling you, basically you need to master this art. Yes, you need to master it. How? Responses. Yes, this one. You need to master it. Now it is time for two past exam questions. I think exam kit I need to upload to the same shared link. Just a minute so that you can download if you don't have. Just a minute, please. Yes, I have uploaded to the same link which I shared with you people here. You can download the exam kit. And you will be reading the question. Green company, first of all. Yes, here we are. Green company. Its requirement, this requirement. Oh my God. Just a minute, I'm sorry. You know, the tech has benefit, but sometimes it hurts. Here is the requirement. Describe 8 audit risks and explain. You see, you have to write in this. 16 marks. So please open it, start reading it, and I will be taking just 5 minutes. I'll be back and I will be discussing its answer with you. So take 5 minutes and I'll be back. Yes, students. Now, the question is green company. It is the 2024 question. 2024 it was tested. March, June. So 8 audit risks and 8 responses to each risk. So information, we will be starting talking about it. Now, so students, it is 1st July 20x5. You are an audit supervisor of Teal and Company, which has recently been appointed as auditor to Green Company. Recently appointed. What does it mean? You're planning your first audit, which will be for year ending, so for the new audit client. The first audit risk, new audit client. You see here, the first risk, 2 marks. The company sells a variety of plants, garden equipments, and garden furniture to wholesale customers and to retail customers via a network of stores. The company was formed 13 years ago by A. White, who is the chief executive and is the company's only shareholder. Aiden is planning to retire within the next year, is intended to sell shares. Now, this is another different example of management bias. Who is the only shareholder? Who is the CEO going to retire? Management bias. He wants to sell shares and he may overstate financial statement items. Okay? May manipulate to show good financial results so that he can sell share at higher price and retire. Okay? Now, so 2 points. Let us go to the answer and talk about, which I have given answer to you people. Okay, sorry. It is not printed out. Okay, just a minute. Let me open that over here. Just a minute, please. The question is open here. Now I will be opening that. Actually, there was some error in opening the file. Yes, here we are. Okay. And now the other one. Yes. So Green Company. Now doing the analysis of the question. Is having the first year audit with the Teal Company. Therefore, it is a new audit client of Teal Company issue. How to explain? The audit firm may not be familiar with the accounting policies, transaction, and balances of Green Company. Therefore, audit risk that they may not be able to plan and perform audit work properly, and misstatements may go undetected. How well explained? Repetition. So they should allocate suitable experienced staff, obtain detailed understanding of company accounts, financial information. Before planning and performing audit. The second point, CEO and only shareholder is planning to retire and all his shares in the company will sell. There is a risk that financial statements are manipulated to show improved financial statements results, and hence higher share price can be negotiated. Therefore, revenues, profits, and assets may be overstated. So they should, again, skepticism should high while auditing green company, especially those areas which are more prone to misstatement, affecting profits. You see here, addressing this risk. Now, come here. The audit engagement partner has a meeting with a White and has advised you the following. The company in August 24, the company began to refurbish the retail store. Refurbishment. In, yes, misclassification of repair and capital expenditure. We have talked about it. So 14.2 billion were recognized in the property, plant, equipment. So refurbishment, the third risk. It may include some repair and maintenance cost, which should be actually expensed, but the company may have capitalized it. So what is impact? Cost understated, property, plant, equipment overstated, and profits overstated. So come here to the answer, IRI. Here it is. Refurbishment costs. Issue, I. What is the risk? Some expenditure may be of maintenance and may have been capitalized. Risk and impact leading to overstatement of property, plant, equipment, and understatement of expenses in financial statements. Now, so what is the response? What is the audit response? Obtain a breakdown of 14.2 million spent on refurbishment. This one, I was telling you, use information specific from the scenario. And capitalize in property, plant, equipment from the management and verify the costs included from source documents, such as invoices, to assess they are of capital nature or not. Now, this is typically substantive test on valuation of asset, non-current asset. Typical. To verify this, what is the risk here? Now, the next point. That this was partly financed by a loan of 10 million, which is to be repaid in 5 annual installments. You see? Repetition, I told you repetition. What is the risk? You need to explain it. That this loan need to be split into current and non-current liabilities. And finance cost should be recognized correctly. The risk is that the split may not be accurate. So same copy paste answer you can do from the notes, that document over here. Just mention 10 million and 5 annual installments. Yes, that will work. In November, Green Company spent 400,000 advertising campaign and the cafe were opened. The advertising expenditure have included an intangible asset and being amortized over 24 months. And as they expect to generate additional revenue. Fifth, clearly incorrect treatment. Advertising cost, clearly IS 38 says it cannot be capitalized. It should be expensed. It cannot be capitalized. Remember that. Clearly incorrect treatment. Okay, come here. Let me take you to the answer. We will see the points over here. So advertising, yes, here. Yes, loan is here. Green Company received financing of 10 million to be repaid in 5 equal installments. It will be classified. How it is arising? Risk. IR. The risk is that may not have classified. An impact, IRI. So now recalculate the split of loan into current and non-current liabilities and verify it is correctly recorded. Substantive test. Now, I have not discussed, I think, the next point over here that I identified. Yes, but there are so many other points. Now come here. Yes, advertising cost, very easy to discuss. Green Company received notification that building authority has received a complaint. The refurbishment has not been performed in accordance with the building regulation. Okay. The authority is currently investigating an investigation, breach of regulation. You know, the points from, how many points are from the same handout? Just count. Provision for legal claim over here, that they may need to pay this amount and may not have recognized it. It is a possibility. So now, how to discuss it? Here is the point. They received notification, complaint, issue. The risk is that fines, penalties may be probable, and company need to record provision for it, and they may not have recorded it. Risk. Impact on financial understatement of liability and provision and expense in the, you see here. Now probability of payment, that may have to pay. Review the correspondence of company with lawyer and likelihood of any amount to be paid on this potential breach of regulation. Addressing the risk. Now, next. Company sell range of tropical plants. In August, Green began a project to develop new technology for maintaining the current temperature and humidity in its greenhouse. It is expected to be completed in August. Cost of 350,000 has been recognized. Now, 7th point, intangible asset, development cost, again from the same handout. There was a reason I told you. Next point is again from the same. In May 25, a flood caused water damage to inventory of plant, which has cost 450,24. Inventory valuation, damaged inventory. Management believe that it can be sold at reduced selling price. Now, come, let us go through the answer. You see here, they have capitalized 350,000, development of new technology issue. As per IES, only a cost eligible for capitalization are as per specific criteria, such as commercial technical feasibility should be capitalized. The risk is that research costs and other costs not meeting the capitalization criteria may be included. Risk, impact. So you can discuss research costs may have been capitalized, which should be expensed. So how to address it? Obtain a breakdown of 350,000 capitalized. And verify it from supporting documentation to confirm whether it is related to research or development. For the new technology developed, perform detailed substantive test whether it is commercially or technically feasible. You see here how easy the question has become. Damage to inventory, flood water damage to inventory, and the company believes plant still can be sold at. This is specific information now. We have not to copy paste answer over here, but we have to take care of it. What is the specific information? Answer should be tailored as per that. So there is a risk NRV of plant may be less than cost. And inventory should be written down, but it may not have been done. Risk. Therefore, inventory may be inventory of plants. So perform substantive test to verify the cost of inventory is below reduced sale price. To assess NRV above or below cost, such as review of post year-end sold inventory price. What was the price charged of those inventory? That will help us to assess the NRV. Yes. Next. So, students, yes, one more point is there. They say that, so they have given other data as well. You see here, we can discuss some more risk. Operating profit falling. Gross profit margin increasing. I have not written its answer. What is the issue? Gross profit margin is increasing from this to this. You will write down. Net profit margin is falling from this to this. The risk is that some costs may be omitted. That's why GP is increasing, gross profit. Or some costs may have misclassified from direct cost to indirect cost, and hence cost may be misstated. Have you noted it down this point? Have you noted it down at this point? What is the auditor response? What will be the auditor response to this? Obtain the breakup of direct costs and indirect costs charged to financial statement this year. Compare with the last year. To identify any omitted or misclassified cost. Ninth point. 10th point. Next. You see here, receivable days are increasing. When receivable days are increasing, what happens? Receivables are building up. Balance is increasing. They are taking more time to pay. They might be struggling, may not be able to pay. Provision for doubtful debts may be understated. That may need to be increased. So So receivable collection period has increased from 40 days to 67 days. Increase in receivable days required to record increase in provision for doubtful debts. The risk is that they may not have recorded increase in provision, leading to risk issue, understatement of provision for doubtful debts, and overstatement of receivables and profits. Review aged receivable analysis of company and assess whether appropriate provision for doubtful debts and bad debts have been charged. Aged receivable analysis that will give idea whether amount is okay against them or not. All right. Now, the next point is, I hope it is clear. So you need to do a lot of practice on it. The next question is Magpie for today. And that is from September, December 2022. This one. Salmon oil risks. You need to calculate some ratios, they said, and salmon oil risk. So please open this question, Magpie. Read it once. Take 5 minutes. I'll be continue that. I will analyze it with you in 5 minutes. Yes, students. Now, so Magpie company, the requirement is again the same. But here they say, ask you calculate two ratios for both years. These two ratios have to be calculated, and this is based on your prior knowledge. Operating profit margin for both years and payable payment period. You need to calculate and write over here. So from this information, operating profit margin, this divided by this, and this divided by this. And payable payment period, you need to calculate. So payables are given. And are there any purchases given? Cost of sale is given. Cost of sale is given. And this cost of sale we can use for the year and multiply with 365. So simple payment periods can be calculated like this. So 2 marks, very easy. So 7 audit risks and responses. So let us start talking about it. It is 1st July 20x5 and you are the audit supervisor at Crow & Company and are finalizing the planning of new audit client, same point repeated. Magpie Company, a retailer of garden supplies which operates from 20 stores across the country and employ 400 staff members. 20 stores located at multiple locations. Inventory count may be a problem, but we will see with the information available. Next. During the year, the company spent refurbishing, repetition from the previous scenario. In our store, all expenditure have been recognized as property, plant, equipment. Now, second point. In addition, the company also installed the new sales system from the same handout, which records all sales and receivables. The company enables daily sale from each store to automatically report to centralized finance department at the end of each working day. So up till now, it is repetition of the previous question, which we have recently done. But I will explain it again. As the system is from a market leading provider, it was not felt to run old and new system in parallel. Great job, great people. So one by one, IRI. So Magpie is a new audit client. Issue. Risk is being explained. May not have enough knowledge and information of control and finance related issues. Risk. And impact on audit, detection risk. This is impact on audit. Now, what is the response? So may not be able to detect. So the planning may be faulty, may not be able to plan and perform work. So experienced staff who should spend sufficient time to obtain understanding of Magpie and then plan and perform work properly. So risk is properly addressed. The company has capitalized 0.75 billion. Issue. Next, what is the risk? That some maintenance expenditure, which is revenue nature of property, plant, equipment, may have which capitalized instead of expensing it. Risk. And the next is what is the impact on financial state? Overstatement of asset and understatement of. You see answer. Auditing your own answer. Now, response, obtain breakup of this. Verify the cost included in it, such as invoices to assess they are of capital nature or not. So, responding. same risk, IRI, the same framework to write the answer. So during the year, new sales system was introduced, but which was not parallelly run. What is the risk? The new system results were not compared with old system for any errors or bugs. Risk. So hence, any issue if there arises, what will be the impact? Sales and receivables, because it is sales system. That may be misstated. Now, very important issue. Discuss with the finance sector. Any issue has arisen since the replacement of new system, and assess their response. Whether what is the assess the response? What they said. It is working properly or not? Now, the next point. Come to the scenario. Customers are able to pay for their goods using either cash or card. At the end of working day, store manager generates a report for each cash register which confirms the cash takings. The cash is then counted and compared to the report. Since the new system was installed, head office now receives daily cash taking report, which has shown an increased number of cash shortages at each store. This difference has not been investigated. Has not been investigated. As small amount. So daily small amount, even they might be collectively, they become material, and it is fraud. It might be fraud. That is the point. A different point over here. So how to discuss it? Daily cash taking report, each report show discrepancy in the form of cash shortage. Only relevant point, issue. This shortage is not investigated as it is small. Relevant point. What is the risk? There may be result of fraud and several may become material. Amount, a material misstatement. So auditor should increase professional skepticism. Detailed substantive test on cash shortages. And test the controls as well. Why they are not working? A bit different. A bit different. Right? Now, majority points are repetitive. The company has a number of corporate customers who buy goods on 90-day credit term, and the level of receivables which are overdue for payment have increased from the previous year. Receivables have increased. And we can see does not intend to further allow repetition. So we can give reference that payable receivable days are increasing. You can see yourself. Receivable amounts have increased. We have to give this example. Very important. That companies' corporate receivables are taking much longer to pay. Days have increased. Now this is issue. What is risk? Allowance may not cover any potential increased bad debts. Risk, impact on financial statements. IRI. And discuss why it is same. Discuss with the management. Despite the fact days have increased, and assess the validity of their response. Next, the payable ledger clerk has carried out supplier statement reconciliations during the year, and a number of instances that statement has shown a balance owing by company which is higher than balance on the list of. No difference is there. What supplier's statement is showing and what company's record is showing. Supplier is telling higher balance. The company's record is showing lower balance. What does it mean? That this difference has been included as a reconciling item on the supplier statement reconciliation, but the payable ledger clerk by the payable ledger clerk, but no further work has been performed. So payable days, if you calculate it, it will be 64 days to calculate. And here there are 81 days. So they are decreasing. Payables overall also decreasing. But supplier statement is showing a higher balance. Company's record is showing lower balance. Supplier says this company has to pay, for example, 5 million. Their record is showing they have to pay 1.3 million. So payables may be understated. Okay? Purchases may be understated. Yes, but if purchases are understated, then payable will be understated. So how to explain it? Issue. And we have validated it with that supplier statement reconciliation. It has turned out company owes more balance than it has recorded on payable list. And it was not investigated. Moreover, payable days have decreased from 81 days to 64 days. What is the risk? Payables recorded are incomplete. Understatement of payables as well as impact. Risk and impact. So this is, you see, this is building argument. So review a sample of GRNs and purchase invoice received from suppliers to verify completeness. So basically the issue of completeness. Payables may not be complete. So completeness test, substantive test. They have included sample of GRN and purchase invoices. They have included or not? Now, the next point is, this was the sixth point. Yes. It has been discovered that soil relating to a batch of plant costing price of 0.1 is contaminated and the plants may not be able to sold. Tests are currently being carried out to determine whether the contamination can be remedied. Now this is again inventory valuation, contamination of inventory, repetition of the points. So contaminated inventory may not be saleable at same price, may need to be scrapped. And we can, along with this, we can see inventory days. They are increasing, you see. Holding for long, obsolescence of inventory chances. So how to discuss them? Inventory of 0.1 million is contaminated. And inventory days have increased. It may not issue. Risk. In contaminated inventory may not be saleable at the same price and may need to be scrapped. Inventory is staying more than longer than the normal, may not be sold at same price. The risk is that company may not have written down and inventory may be overstated. Impact on finance statements. So review post-year and sale of inventory. Identify selling price, whether it is above cost or not, and assess a written down is required or not. Discuss the estimated cost to fix contaminated inventory with management and estimated selling price to assess whether write down will be required. Very important. When inventory is damaged, contaminated, need to be fixed. So this is important point to assess its NRV. Now, so this question is complete over here. So students, you can see how many points are repeated. So you need, but again, 4 to 5 points that they are in every question same. But you must be able to draft it as per scenario. Some variation, minor variation may be there. I am giving you a home assignment to solve a question and send me. And the question is, yes, you will solve question that is night electronics. This is done. This is done. Night electronics. Plus, I will be sharing with its answer with you. I will be trying to create some more videos, 2 questions during this week, and will be sharing with you. Okay? As per the plan. Yes, just a minute, please. Yes, we have 1.5 lecture on audit risk. Okay, means next class, again, we can discuss 2 questions, 2 scenarios next week as well. So 2 scenarios next class. 2 scenarios I will share recording. 2 scenarios I have solved, done today. You can solve night electronics and send me. And I will give one more assignment on the same in the next class. And only audit risk part, not the full question. Okay? And you have to solve in the columnar format. Column, the same exam format. This one, in this way. Any question from your side? Any question from your side? All right. God bless you. See you. Take care. Goodbye.